Welcome to our deep dive on whether you should remodel or move in today's mortgage environment. In this video, we will explore why locking in a low mortgage rate changes the traditional advice and how that influences the financial calculus. We will cover costs, risks, timelines, and decision frameworks. Let's begin by setting the agenda and then move into the financial reality check. Here is our roadmap. First, we'll show how low rates transform the decision. Next, we'll perform a financial reality check that includes hidden transaction costs and long-term interest. Then, we will discuss when it makes sense to renovate versus move. After that, we will address risks and how to manage them. We will follow with a practical planning guide. Subsequently, we'll visualize the decision using diagrams and timelines. We will also include quick quizzes to validate your understanding. Finally, we will conclude with key takeaways and a verdict. Conventional advice often favored moving instead of remodeling. However, for homeowners with a mortgage rate below 4%, the math shifts dramatically. Your low interest rate effectively becomes a valuable asset that you stand to lose if you move. Therefore, we need to unpack how transaction costs and higher interest rates combine to make moving potentially far more expensive than staying and upgrading. With that context in place, let's transition into the financial reality check. Let's quantify the reality. First, your current low mortgage rate acts like an asset. If you replace a loan under 4% with a new mortgage near or above 6.5%, you'll often pay significantly more interest across the life of the loan. Second, moving involves substantial transaction costs. Between selling and buying, total costs commonly approach 12% of the property value when you include commissions, closing fees, transfer taxes depending on jurisdiction, and moving expenses. Third, a six-figure addition or remodel may seem large, but it is often less costly than decades of extra interest at a higher rate. Finally, when you evaluate the numbers side by side, maintaining a low monthly payment tends to outperform starting a new 30-year mortgage at a substantially higher rate. Now, to make this concrete, let's look at an illustrative comparison table. This table provides a simplified, illustrative snapshot. Assume a current home valued at $700,000 with a $400,000 mortgage at 3%. The principal and interest payment is approximately $1,686 per month. If you instead move to a $900,000 home with a $720,000 mortgage at 6.5%, the principal and interest payment might be around $4,550. Over the first 10 years, the lower rate loan may accrue roughly $110,000 in interest, whereas the higher rate, larger loan could accrue around $420,000. Additionally, buying and selling can incur combined transaction costs approaching 12% of the new home's price, which in this example is around $108,000. By contrast, staying and investing $160,000 into a remodel may keep your monthly payment structure more favorable. These figures are approximations for illustrative purposes. Actual numbers will vary by lender, market, taxes, insurance, and down payment. Next, let's compare the qualitative pros and cons. On the remodel side, you preserve your low-rate mortgage, customize your space, and remain in a familiar neighborhood. Kitchens and bathrooms typically add the most market value. However, you must endure construction disruption and manage contractors and permits. On the move side, you gain a new location and potentially a layout that meets your needs immediately. Yet, you likely lose your low-rate mortgage, face a higher monthly payment, and pay substantial transaction costs. The longer-term interest burden can be much higher. With that comparison in mind, let's formalize the decision path using a flowchart. This flowchart starts by asking whether your mortgage rate is below 4%. If it is not, the advice is to run both remodel and move scenarios and select the best fit. If it is, we then ask whether you absolutely need a new location or school district. If you do, consider moving, but make sure to price in the higher monthly payment and transaction costs. If you do not need a location change, we next ask about your time horizon. If you plan to stay for less than 10 years, avoid a major addition and consider lighter updates that are easier to recoup. If you plan to stay 10 years or more, check whether you have a budget in the range of $100,000 to $200,000. Without that budget, phase your upgrades and prioritize kitchens and bathrooms. If you do have the budget, proceed to remodel, but secure a reputable contractor. Ensure permits are in order, and include a contingency of 20 to 30%. Additionally, evaluate your tolerance for disruption, which leads to living in place during the remodel or securing temporary housing. The final principle is to leverage your low rate wherever possible. Renovating shines when you want to remain in a neighborhood you already like and understand. If your primary need is better daily function, such as a new primary suite, a larger kitchen, or improved circulation, remodeling targets those needs precisely. Renovation becomes more compelling when your ownership horizon is 10 years or more, because you have time to enjoy the improvements and potentially benefit from appreciation. It is essential to be realistic about returns. Large structural additions seldom produce a one-to-one immediate resale payoff. Instead, they provide lifestyle value first. Now, because renovations carry risks, let's discuss the most critical ones and how to mitigate them. Renovations frequently exceed both schedule and budget. Projects can take twice as long as planned and cost 50% more than originally estimated. Mitigate these risks by hiring reputable contractors, verifying licensing and insurance, checking references, and confirming realistic timelines. Additionally, understand the permitting process for your jurisdiction, including lead times and inspection milestones. Maintain a contingency of 20 to 30% of the total budget, and plan your living situation to accommodate disruption. With those risks in mind, let's move to a practical planning checklist. Approach your remodel as a managed project. First, define your scope with clear must-haves and nice-to-haves. Second, set a budget that includes a 20 to 30% contingency to handle surprises. Third, investigate permits and zoning limitations before you finalize plans. Fourth, solicit at least 3 competitive bids and verify each contractor's license, insurance, and references. Fifth, establish a realistic schedule and determine whether you will live in the home or secure temporary housing. Sixth, order long lead materials early to prevent delays. Seventh, phase the work to preserve access to critical spaces like bathrooms and the kitchen. Finally, perform inspections at key milestones and track change orders in writing. With a plan in hand, let's visualize the timeline from permit to move-in. This timeline outlines a typical major remodel. The idea and scope phase may take 2 to 4 weeks. Design and bidding could require 4 to 8 weeks as you iterate on plans and evaluate contractors. Permitting might take 4 to 12 or more weeks, depending on your jurisdiction's backlog. Demolition and framing typically run 3 to 6 weeks. Mechanical, electrical, and plumbing rough-ins might require 2 to 4 weeks. Inspections often add 1 to 3 weeks. Finishes, including drywall, cabinetry, tile, and paint, could take 4 to 8 weeks. Finally, the punch list usually takes 1 to 2 weeks. Each of these durations can easily extend due to surprises, supply chain constraints, or permitting delays. Next, let's quantify the cost split in a simple pie chart. In this illustrative pie chart, the largest portion represents long-term interest from taking on a new, higher-rate mortgage when moving. The next largest wedge is the remodel budget, which is significant but often less than the incremental interest you would pay by moving. Transaction costs occupy a sizable slice, reflecting sell and buy expenses. The final slice accounts for contingency and living disruption costs during construction. These percentages are representative and will vary substantially by region, project size, and financing structure. With costs and timelines visualized, let's test your understanding with a quick quiz. Question: with a 3% mortgage and a need for more space, which option is typically financially superior in today's 6.5% or higher rate environment? Options are: A. Move and take on a new 30-year mortgage. B. Remodel and keep the low-rate mortgage. C. Sell, rent for a year, then buy later. D. Do nothing and hope prices fall. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Remodel and keep the low-rate mortgage. Preserving a sub-4% mortgage often saves far more in long-term interest and avoids substantial transaction costs compared to resetting a new 30-year mortgage at a significantly higher rate. Question: if you plan to sell within 3 years, should you commit $160,000 to a major addition? Options are: A. Yes, because you will get a 1-to-1 return immediately. B. Maybe, but only if it is a kitchen or bathroom refresh. C. No, because large additions often take too long to recoup. D. Yes, if contractors are available quickly. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Major additions are typically lifestyle investments and rarely return dollar for dollar in the short term. If your horizon is 3 years, you are unlikely to recoup the full cost. Lighter updates, especially to kitchens and baths, may be more prudent. Let's walk through an illustrative calculation using simple approximations. The current loan is $400,000 at 3%, with principal and interest around $1,686 per month. A move-up purchase implies a new $720,000 loan at 6.5%, with principal and interest near $4,550 per month. Over the first 10 years, the higher rate, larger loan may accumulate roughly $310,000 more in interest than the smaller low-rate loan. Additionally, buying and selling can add around $108,000 in transaction costs on a $900,000 purchase if the combined costs approach 12%. Meanwhile, a remodel budget of $160,000 can directly improve daily life without resetting the entire mortgage. And features. The takeaway is that the extra interest and transaction costs can exceed a six-figure remodel by a wide margin, though your specific numbers will differ. Now let's summarize the key points. These are the core lessons. Your low-rate mortgage is an asset and worth protecting. Combining transaction costs with higher long-term interest often makes moving quite expensive. Renovation is most compelling when you intend to stay at least 10 years and need functional improvements. Large additions are primarily lifestyle investments, so keep expectations realistic. Plan for timelines to slip and include a contingency of 20 to 30%. Overall, the verdict is to leverage your low rate and upgrade what affects your daily life the most. This content is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique, and market conditions, interest rates, transaction costs, and regulations vary by location and over time. Consult qualified professionals, including a financial advisor, lender, real estate agent, contractor, and tax professional, before making any final decisions. With that in mind, let's move to a concise summary. In summary, today's low-rate mortgages significantly alter the remodel versus move decision. Always run the long-term math and include both interest and transaction costs. Choose remodeling when you like your neighborhood and intend to stay for a decade or longer, prioritizing high-impact spaces such as kitchens and bathrooms. Expect that projects will take longer and cost more than planned, and build a strong team while maintaining a contingency. The overarching verdict is that, in today's environment, leveraging your low rate to fund targeted upgrades is usually the smarter financial strategy. Thank you for watching. If you found value in this video, please like it, share it with a friend who is debating a remodel versus a move, and subscribe for more practical breakdowns. What is your plan? Will you remodel or move? Share your thoughts and questions in the comments. We look forward to hearing your perspective.